Good morning and welcome back to another East Capital webinar. My name is Massimo Grassotti and I'm part of the investor relations team here. Today we are joined by East Capital's CIO Jacob Grapengiesser here with me in the studio, along with Senior Analyst Hao Zhang calling in from Hangzhou. The two of them have been out traveling over the last couple of weeks, ranging from Delhi to Seoul and Shenzhen, and would like to hear more about it. At East Capital, we pride ourselves on being local and on the ground of the markets where we invest. And this is proven not only by our investment management team traveling as much as they do, but also the fact that we have members of our team such as Hao based across the world. Over the next 20 minutes, we aim to cover a range of topics from growth in India, leading sectors in South Korea, and company cases we like to capitalize on it all. So without further ado, let's begin. Jacob, welcome.
Good morning.
Good morning. Thank you for being here with us today. Now, I know you've been traveling a lot. You've been in both Delhi and Seoul. Let's focus first on Delhi. What were sentiments on the ground like? What did you see? What did you notice? Tell us a little bit. Big view, what you thought.
Well, the Indian market and economy has been doing extremely well. So the sentiment was super positive. The problem is that because of that very positive sentiment, it is getting quite difficult to find companies at attractive valuations. Many of your typical consumer stores would be trading at 50, 60, 70 times earnings. And then, of course, with our investment style, we argue what's left. Can we actually make money here at these type of valuations? So I think India is the most difficult market in terms of finding good stock picks. We need to spend, bluntly speaking, the most amount of time to find an interesting company. On the other hand, if you do find it, then the potential is of course enormous. And I do think that the portfolio we have in India today is absolutely great. It's super off benchmark, some unique stock picks that are attractive in valuation and capturing this type of growth.
Right. And so if we touch a little bit more on that, right? I mean, there's this India growth story that we have talked about being there, just as you say, and that is important and it takes time. What are some of the sectors that have really benefited most from this economic growth? And then maybe also mention how is our fund exposed to those trends in those sectors?
Yeah. So if we take a step back, India is I would call it old style emerging markets where the population moves into the middle class and hence can start to consume different things. I just wrote down here, but at 1,100 GDP per capita, you start to buy your first TV set. At 1,700, the first washing machine. At 3,000, the first aircon. And India today is at 2,600 per capita. So they're just about starting to buy aircons. Of course, there's a spread in population, right? But this is the average. And this is also why the companies are that expensive, right? Because if you're betting on an aircon maker, we can't really buy that because we're not a client fund. But then you're just about there. The growth is sort of kicking in. What we have been looking at is the healthcare sector. The amount of hospital beds. I met one of the largest entrepreneurs in this sector. He made more than $1 billion, I think, in 2 years. So well done for him. But the amount of beds in India, private sort of high quality beds in hospitals is 70,000. In the UK, it is 140,000. Now I'm actually excluding some of the state hospitals, which are probably a bit kind of subpar in terms of quality. So you have half the number of high quality beds as you have in the UK. Another way to see it is to compare to China. China is at 5.6 hospital beds per 1,000 inhabitants. India at 0.5. So they need to grow 10 times or rather 12 times to get up to the same level as China. And I think this is how we think. And then we say, okay, so healthcare is probably a theme that is interesting. Let's say that they get to a third of China, then they still need to grow 200%. Just make some conservative assumptions. Then we start to look at the healthcare companies, realize they're quite expensive because of this. But we find a company called Aster Healthcare, which is trading at I just wrote down the valuations here, but it's trading at 8.5 times earnings for next year, or P15. I think that's reasonable. 15 times earnings for next year. Again, peers at 30, 40, maybe even 50 times earnings. So this is how we try to approach things. We try to say, okay, India will grow at 7-8% per year. Within that, which are the high growth sectors? It's probably not going to be washing machines because people on average already bought those washing machines, right? But healthcare will be a growth sector. And then how do we find exposure to healthcare in a way that is cheaper than the average on the market or than many of our peers?
And so then, I mean, touching on that, right? I mean, how important is it really to be on the ground and find these? Because you don't find them as easily, right? You mentioned we have these off-benchmark names, and to find them, I imagine you really must be on the ground to meet these companies and find them and see what's going on.
I can just give you a very simple observation. I attended a conference. We went to see some of the hospitals. We did not just went to see Astra Healthcare Hospital. We went to see another company's hospital. So, most of the investors, they would probably invest into that company. It's a good company, so it's double the valuation. I then went on my own to see a company called Renew. Renew was not attending the conference, and this is a renewable energy company. This renewable energy company, first of all, in terms of valuation, it is trading at 7 times EBITDA for next year. Again, that is quite cheap by Indian standards. It is listed in the US, so the corporate governance standards are quite high. We would probably assume that at least. And in India today, it is 60% coal-fired generation, only 10% renewables in the energy mix. But the IRR from renewables is 18%. Hence, there's a very large demand.
Right.
The irony, and now I'm getting into the details, is that if you buy with a long-term contract from the likes of Renew on a per kilowatt hour basis, on a cost basis, actually it's 20-30% cheaper.
Wow.
So you secure a long-term contract if you're a big corporate, a big factory, and it's 20-30% cheaper, and it's renewable. I mean, why wouldn't you do that, right? And for the company, Renew, and some other companies, of course, but this is the only company I think that is listed that you can get a direct exposure. You get your 18% IRR. They are now at 8 gigawatt of capacity, but they will grow this capacity by 2 to 4 gigawatts per year. So they will grow 25 to 50% per year. So it's just amazing growth rate, of course, right? And finally, Hao would know more about this, but actually the cost of solar panels globally is now coming down because the price of polysilicon, which is half the cost of a solar panel, is coming down. And because of that, the IRRs of this company is actually going up even further. So, it's like a very specific story. This company is not attending any conferences, but when you go and see them, it's absolutely amazing. And finally, the company is now working with AI to optimize all their processes and electricity generation. And this actually adds 1% to the yield. It doesn't sound that much, but the yield on average is maybe 25%. So it actually adds then 4%, and that 4% all goes to bottom line. And I think it was quite cool when I went to see their control rooms and how they optimize the processes in AI, and then you can just measure basically how much more money they make out of this.
Oh, really interesting. And then you touched on it a little bit, and how thankfully we do have you on the ground. Thank you for joining us as well today. And so you were in Seoul this week at a conference. Give us a little bit about what you noticed being over there. Also, consumer confidence, as it just hit 1-year high. Tell us a little bit about what you saw.
Hi, thank you. So I was in Seoul, actually attending 2 conferences in the last 2 weeks, one with an international bank and then another one with a local broker. My overall impression is that people are quite positive about their second half GDP improvement, mainly driven by semiconductor export recovery. So just to give you some background knowledge, overall, I think IMF expect around 1.5% GDP growth for 2023 this year, and then some of the local economies were expecting slightly higher or slightly lower. But if you look at what comprises of Korea's GDP, 80% of Korea's GDP is actually from trade, based on World Bank data in 2022. And then majority of that is semiconductors, electronics, automobiles, etc. So far this year the number wasn't great, and then we're likely seeing May numbers soon. It's very likely going to be like the 15th consecutive month of trade deficit, which is not great. But people are expecting this to turn starting from second half, which will be a major driver for their GDP growth. And then in terms of other aspects, investment is not somewhere that people put a lot of faith in Korea, given the current corporate environment, and the infrastructure investment will be not great given the declining housing prices, etc. You mentioned consumption, and indeed consumption has been resilient this year, with services better than goods overall. But a lot of people have been cautious, and then the reason is really because Korea started rate hikes in third quarter 2021, and then economists were thinking it's very likely after 6 quarters those rate hikes impact will start to show in consumption, which is somewhere like first half this year. So a lot of people are being cautious on consumption overall, but again, overall people are being optimistic about second half given semiconductor cycle, export cycle bottoming out. And then I do want to mention one positive thing about Korea is that they would probably be one of the first country to exit from the rate hikes cycle. They started the rate hikes from third quarter 2021 from 0.5 to 0.275, and this year they reached 3.5 in January. And since then they have not been increasing their rate anymore. And people are expecting their CPI to reach 3.7, 3.3 this year and 2.0 next year. So they're really well on track of hiking their rates and then cutting CPI. Allowing CPI to decrease. So overall, Korea economy is overall improving. And if we look at the market, I'll quickly say Kospi has actually entered a technical bull market just recently after rising for 20% since September last year. And then at the valuation right now is 15.1 times last 12 months PE. And then the average for the last 10 years is like 15.8. So rebounded from bottom last year, but still quite affordable or reasonable. Given the growth, I think it's a good place to have a look at.
Okay. How you mentioned a little bit there about semiconductors, right? I mean, we know that South Korea is a key player in, amongst other things, also then the EV cycle, right? I mean, did you meet any companies on your trip? Could you explain to us a little bit more about the competitive sectors over there and what big opportunities there are in South Korea?
Sure. Yeah, so I mentioned semiconductor, but when you talk to people and investors, what they really like about Korea is number one, semiconductor, number two, EV supply chain. So for EV and batteries is also one of the sectors which we like about Korea as well. And if we look at the trade data, EV is actually the only sector that shows positive export growth for Korea. And then the key thesis about investing in Korea's EV supply chain is that it is the only place where you can have a large-scale production value chain outside China. So we have been seeing LG Energy Solutions, Samsung SDI, SK Innovations, etc. They have been all talking about expanding in Europe, in the US. So that's really the benefit of investing into Korea, which is under the current circumstances where people don't want to have the China risks, but still wants to enjoy the growth in this sector. So Korea is the only place where they can go. And in terms of the subsectors, for EVs, OEMs, we have been cautious given the competition. We all here heard about all OEMs cutting their prices. So we are a bit cautious on the EV side. For batteries, the stories are perfect. I met quite a few battery companies and then material companies. But then the things that I would watch out for is that most of the company has already pressed in till 2025, especially about the US Inflation Reaction Act, which is basically saying if you're not from China, we'll give you subsidies. So most of the company have pressed in that, which is not necessarily a good thing if you look at the share price, because the valuation has become more expensive. And then the last thing I mentioned about the EV supply chain is that earlier this year we saw a lot of share price, I would say, rally for the material side, which was mainly driven by retail activities. So for those, I did met several great companies which I do want to invest in later. If the prices or the share price came down and then the valuation came down. I think the current high valuation wouldn't be sustainable given the metal prices are coming down. So very likely their earnings will come down as well. And for the people that I might, most of people are thinking like how much they should add to their short positions. So in conclusion, I would say we just need to be selective into which area we want to go into and be patient when the valuations are really expensive for now.
Good, Hao. Thank you for that. And we're going to touch a little bit more on South Korea with Jacob in a second here. But just one last question to you, Hao. Just give us 1 minute quick update. You are based in China. It has a little bit investors' expectations with regards to this lens of economic recovery and sentiment. Just give us 1 minute quickly what's going on and what do we need to know?
Sure. I was in China, actually in Shenzhen earlier this month. I would say the local investors were very cautious about the outlook for first half this year, and then what they're really looking into is the second half in 2024. And then a lot of people have been complaining about the difficulty in trading in China, giving all the focus right now for the investors in China are on AI and then SOE reform related. In terms of the fundamentals, I do agree with you mentioned China's recovery is lagging as well, which is what everyone was saying. And then earlier today, we are seeing the April PMI number came out meeting consensus, given the weak demand both inside and outside China. So overall, I would say the environment is weak, but also another way of looking at this is that it's a very good environment to look for new ideas and ideas which are really fundamentally solid, given the sentiment is really weak and people focus too much on AI and SOE reform. So because of the oversold part of the story, I think it's a good time to really go for the good companies. Sorry, that's my conclusion.
Hao, thank you very much for that. Jacob, turning to you, 2 last questions. You were also in Seoul. Anything noteworthy to add to what Hao said? And then also, we did touch on that we are off benchmark in a lot of our portfolio. What are some interesting off benchmark names we have in Korea?
Yeah, thank you. I think for the EV side and batteries, now everything looks absolutely great. There is huge demand for these batteries. Margins are relatively high. Yes, CATL, which is the largest Chinese producer, they cut their prices, so they hurt their margins for themselves and for the kind of Chinese part of the value chain. The other big producer is Korea. But I think if we take a slightly longer term view, let's say 5 years, maybe there will be oversupply of batteries. It's technologically quite difficult, but the capacity increases we're seeing are absolutely enormous. And hence, I think we should ask ourselves, what is the correct valuation and how is actually the underlying contract structure? And as always in China, they just increase capacity like crazy without maybe real underlying contracts. We own a company called Samsung SDI, So they supply, for example, to BMW, so to premium cars, and they have 20-25 year contracts. They are effectively guaranteed a margin for 20-25 years. Whereas if you just produce batteries for cars and sell them, you are going to be squeezed.
Yeah.
If you look on any automotive component manufacturer, which doesn't have a unique technology over the past 50 years, I mean, they were all squeezed to very, very thin margins. So that to me is the next question and next debate that we need to have on the EV battery side. And then our holding here is Samsung SDI, which is, well, I wrote down the valuations here, but it's now trading at 20 times earnings for next year. But that's again with very high growth and 20-25 year type of contracts. So I think that's okay, but I would be just a little bit cautious with these batteries in general and just buying everything, you know, which sometimes investors do just thematically. You really need to separate between the companies here. I think the most exotic company we have is a Korean golf wear producer. They actually bought some of the European famous golf brands, and this is perhaps a bit of a too unique company, but it's trading at 3.3 times earnings with 10-15% growth. The bet is actually that more women start to play golf in Asia and in Europe as well, but more Asia, and women spend more on their appearance, at least in Asia, but I would probably say that's true in other parts of the world as well. So it's just steady 10-15% growth, 3.3 times earnings. The reason why it's so cheap is because their warehouse actually burned down last year, so a lot of their inventory was lost, but now they rebuild that in the inventory. And the company is also extremely bad at communicating to the market. Okay. So our largest engagement with this company is just that, you know, please hire an IR. They are now hiring an IR person, investor relation persons, can speak to the market, please attend conferences, please just make other investors aware of the story. It's a great company. They just don't know what it means to be listed on the stock market.
Which is very, I mean, this is our bread and butter, right? Finding these small companies. So yeah,
again, this is probably one of our most exotic companies, but you know, it's fine. It's a small position at 3.3 times earnings. I think we can live with that.
Thank you very much, Jacob.
Thank you.
Thank you, Hao, for taking the time, and thank you to everybody dialing in today. As always, if you'd like to hear anything else, or if you'd like to speak to any of our team members, set up calls, please feel free to reach out to any of us here on the IR team or any of us here at East Capital Group, and we'll be happy to help. Thank you.